All right, guys, let's get started with this market update. So today, interestingly enough, I had a client meeting and the client had asked, well, what's our reinvestment strategy or what's our reentry strategy to the market? I was shocked to hear that from a client. I thought all clients at this point, we've got everybody into cash. We got them into cash about a week to a week and a half ago now. So we saved a lot of clients from the majority of this downturn, but some people are already thinking about, well, now that the market's down about 30+%, right, 32%, what am I going to do? If I recall from the last video, I was saying, look, cash is a position, stay in cash, be patient, do not rush back into this market. We're seeing something truly historic. This cannot be compared to any crash in the prior, say, 4 or 5 crashes. This is not 2008, not 2001. It's not 87. It's not 1929. This is just unprecedented on every single level. You can't create a roadmap here because this is completely different than any other time in history. So what I would say is again, cash is a position. Be patient. Do not look to re-enter this market immediately. And if you do want to get back into this market, kind of dollar cost average back in, get in slowly over the next year or two, but do not just pick a spot and dump everything back in. With that said, I want you to understand something as well. This doesn't happen too often, but when equity prices go down, as you can see here, normally you get a run into bonds. But I think we've talked about in the past emails and videos that this was a kind of intermediate term top. And, if you look at this move from July of 2019 to late August of 2019, it was a 13% rise. At that point, that was something that was relatively historic. This right here was something that caught a lot of people's attention because of how quickly the bonds in this ETF had risen. It tapered off a little bit, but now what we're seeing is something truly historic. You are seeing a move that it went from, let's just say, after the breakout at 148, you saw another 20% move up from there. This is a complete overvaluation of bonds, completely. It doesn't matter. People were swarming into bonds at a historic rate. And the reason was because they were scared of coronavirus. So what do people do when they feel like there's some uncertainty and there's some risk in the market? They go to bonds. Well, the problem with that is they rushed in at historically quick levels. I'm sorry, historically fast. So they got in, they dived in head first, and what this did is it took out, and many of the guys in this group that I talked to, we were talking about refinancing your mortgage because the 10-year had did something truly historic. Now, right now it's at 127, but if you take a look at this, it's probably the best way to put it. So after it took out its August of 2019 low, it went down another 70% from there. Okay, 71%. From there, it went up 247% ish. Okay, so at one point it was down at 0.41. Now it's at 1.27. And one of the main things to take from that is normally when the 10-year and the 2-year yields cross, it's a recession signal. And they had briefly crossed somewhere around here. So we caught one of the more reliable recession signals, and it had lasted, I believe, for a few days. We are out of that right now, which is good. But again, with all the uncertainty in the market and with the coronavirus, really, really putting a damper on economic growth throughout the entire world, bonds are probably going to remain a place that people go into regardless of the blow off. So if you had to, gun to the head, now look, it all depends. If you're a retiree or near retirement, you need to protect your money. If you have a time horizon like I do, I'm 33 years old, and I have at least 20 to 30 years of investing left in me, I essentially have an infinite time horizon. If gun to the head, I had to put money in the market right now, this is how I would do it. So I want everybody, when they're done with this video, and again, I'm going to try to make in this video a little quicker than my prior ones. I want you all to go to finviz.com. My version of Finviz, I have Elite, but you don't need Elite to do what I'm doing. I want you to click on dividend yield. I want you to go greater than 5%. Go find yourself an IPO date of 20 to 25 years. Basically, we want a company that's been in business for a while. I want you to click on fundamentals. Now, I want a profitable company. I want low levels of debt. I want forward PE, meaning that likely to be profitable in the future to be profitable. And I want a price to book value under 1. Now, price to book is the key to all of this. And what that means is that you can liquidate the company for fair market value. And the price of those assets, which is the book value, would be less than the price of the company. Okay. So it's really a market cap equation. So if the market capitalization of your company falls below book value, that means you're under 1. So you can do this maybe if you want to do under 2. I like under 1 for right now because I can really show you how undervalued some of the best companies in the world are. So again, before we get into looking at the individual companies, I want you to understand something. IPO date, more than 25 years. If you've been in business for 25 years, that means you've gone through a recession. You've gone through low oil prices. You've gone through low yields. You've gone through high yields. You've gone through a quasi technology blow off. You've gone through 2 recessions, at least. So if you survived and you have a high dividend and you're profitable and you don't have a ton of debt because you got to pay interest on that debt. So we don't want a company who's paying a dividend but is cash constrained. So we want the debt to be at least under the equity by 1, by a factor of 1, I mean. And the price to book value needs to be low. So we want the company to be currently priced at about what it's worth. Let's dig in. So one of the first things I like to do, so if you're on page 1 of this, I want you to click on PE, and you can start with the lowest PE, okay? So price to earnings ratio. One of the things that sticks out right away is this Big Lots, and one of the things I'm going to do is I'm going to go to dividend.com. And what I want to do is really show you. So now dividend yield is a little tricky because the yield of a stock, the yield of a company, will go up when the price of that stock goes down. So over the last 3 weeks, the dividend yield of ExxonMobil, for instance, and Big Lots has risen. And you want to find companies that are really, I don't want to do that. Okay. You want companies that are 1, not going to cut their dividend, 2, going to continue to pay their dividend, and 3, you want a really good yield. So let's just take a quick look at Big Lots. So for Big Lots, which is likely a recession play, right? Because you're doing discount variety stores. So when you're trying to save money, every little bit counts. You're going to go to discount stores. So think Dollar General, think Big Lots, think Job Lot. Dividend yield is 8.78%. This is probably I guess this might have factored in today. Big Lots was down about 20% today. Unbelievable. Just unbelievable. Their dividend growth, they've been growing their dividend over the last 4 years. They're paying out $1.20 per share. And again, their yield is 8.78. Now, if I were to compare that to something like an ExxonMobil, also, if you go to that FinViz scan, you'd see this here. Dividend growth. They've been growing their dividend for 37 years. They've seen $20 a barrel oil. They pay $3.48 a share. That's nuts. And their dividend yield is 10.09%. One of the other interesting things too, their earnings per share is 2.89. That means the payout ratio is 120%. That means they're paying out more in dividend than their current earnings. Now, we could get a little deeper into that. This isn't the first time this has happened for ExxonMobil, because ExxonMobil has been in business forever, because they have so much cash, and because they're just a cash flow machine. Even thinking recessions, you need to fill your tank up with oil, right? With gas. So I would be a little bit worried, but not completely worried, because I know they've been here before. So you can get ExxonMobil for $33 a share with 10% dividend yield. Okay. So even if they were to cut that dividend yield down a little bit, let's say they brought it to 5 or 6%, and they dropped it. Look, that's still a great yield for a company that makes money. And especially if you're going to be in this investing over the next 20, 30 years, to be able to get ExxonMobil where it is now, to give you an idea of where that is relative to where it's been. I mean, look at this thing. $33 a share. The last time we've seen these prices is 2003. 2003. It's absolute carnage in the energy space. But they pay a huge dividend. And here's the thing. The market prices in future risk. And so this drop in ExxonMobil has just priced in as much coronavirus risk as it could, and it also priced in the Saudi Arabia, Russia oil kind of glut that they're pumping into the market. So is there still risk in ExxonMobil? Yes. Has a lot of the risk been priced in? Absolutely. You cannot say at this point that this is not a bargain. Does that mean you rush in and put everything you have into it right now? No. But what I'm saying is that a month or two ago, you could have got it for 70. Now you could get it for about 50% off. So if we're talking about a long-term time horizon and you want some dividend right now, this is a great place to go. Now understand something. With the coronavirus dampening down growth in the future, you don't want to go to growth names. So if you're a consumer discretionary stock, you want to stay away from those names. And the reason is because nobody's going to be spending. Nobody's going to be going to retail stores, okay? If you can't get your Lulu delivered to you, what are you going to do, right? So Lulu is a great example. It's funny because I think we had mentioned this, that Lulu would one day get to 80. Well, it's down about 50% from the high of the year. And I know I'm going to say only, and only may sound crazy, but it only has another 37% to go to get to 80. So consumer discretionary is going to get killed. It is. Leisure is going to get killed. So if you look at Las Vegas Sands, okay, just getting absolutely destroyed, 50+%. You look at Wynn. Okay. So anything in the consumer discretionary space, which is pretty much leisure, retail, apparel, like things like that, like nobody's going to be buying any of that stuff for a while. So Wynn down 73%. So when you're looking through this list, I want you to understand that the whole point of this list is to generate companies and stocks that are going to pay you a high dividend yield and are likely going to retain that dividend. You do not want a company that pays a dividend and has a shitload of debt. Okay? So you don't want any of these companies that have debt over one. And the reason for that is because when it comes time to pay that debt, okay, regardless of how cheap of a company they are, they have to pay the debt. And if their sales are going to be depressed, if their earnings are going to be depressed, that means they're not going to have the cash flow to pay the dividend. So you want to find companies that don't have a lot of debt. It's very important, extremely important to find companies without a lot of debt, because that's a good way to protect the dividend that they're paying. Okay. So the next thing I like to do now that we've so you can look at the PE and do it by that. But then I also like doing, especially in this time, doing the industry. And what you're looking for here, again, so if you find any consumer discretionary, you want to stay away from that. So brewers. The interesting part of brewers, beer and wine and things like that, they actually hold up pretty well in recession. And the reason is that I'm not just Americans, not just the United States, but basically you're going to eat, you're going to survive, and you're going to drink when times are tough. So brewers actually hold up pretty well in the consumer discretionary space. Things like department stores, Kohl's, Macy's. I mean, I can't believe Macy's hasn't gone out of business yet. That's unbelievable. So you want to stay away from those. Big Lots, again, that's a great one to look at. As far as investing now, if you have to put money into the market, that's a good place to do it. If you want to look at some basic materials, again, there's still risk in getting into these companies, but a lot of the risk has been priced in at this point, and they provide a good risk to reward going forward, especially over the next 15 to 20 years. So you're going to see a lot of oil and gas, independent and major. A lot of companies in the financial. Actually, let's take a look at the financial space. Financial spaces has a lot of really interesting companies in it. So a lot of regional banks. I think I saw Huntington Bank in here somewhere at some point. But yeah, so a lot of these like Webster, Key Corp, AIG. Look, as long as there's not a run on the banks, if interest rates are going to rise again. So let's go back to the yield. So I don't want to say it's safe to say, but with the way that yields just bottomed out, banks do better in a high yield environment because they have more room to play with the spread. In a low yield environment, banks are terrible. So you just bottomed out on the yield. If yields are going to rise, banks aren't a bad place to put your money. So here's a bunch of regionals. You got Webster, Key Corp, American International, First Horizon, Associates, Banco of Argentina. So these are companies that, again, have likely priced in a lot of the risk going forward. Again, like, look, the market's going up and down 2,000 to 3,000 points a day. There's risk in this market right now. But if you had to put money in the market, these are some of the places to go. Can't stress that enough. So here's some of the other, like Fifth Third. So again, we're looking at companies with low debt. They're profitable. They're being priced at less than what they're worth. And they've been in business for 25 plus years, and they have a high dividend of over 5%. So you can trust these companies likely to get out of this. Okay. So like we're in the worst of times right now. And, when this too shall pass, when that happens in 6, 9, 12 months or whenever, these are the companies that are going to survive and that they're still going to be paying you a dividend and likely will have appreciated at that point. So take a look here. These are great companies to get started with. If you're looking at mutual funds, I highly, highly, highly suggest you stay away from mutual funds that have holdings, that have the top 10, top 20 holdings be growth names, software. I'm still look, like Apple's going to be in business as long as we're all alive. But here's the problem. That's how far away from trend it is. So back in 2012 and 2012 to say 2013, it got away from trend. It came all the way back. Again, in 2015, got away from trend, came all the way back. Got away from trend, tried to come back, didn't come back. Now we're talking about being, so that if this is your regular trend, standard trend, momentum trend, parabolic. And look, I don't know if we looked at raw stores. This is a great example. You want to go parabolic like that, I don't care how good of a company you are, and Raw Stores is a very, very good, solid company. They got cut in half. Okay, so Apple is definitely going to go through some pretty hard times. The only thing that's saving them right now is that they do pay a dividend, which allows them to be bought up by a lot more mutual funds. So the institutional ownership on Apple is very high, which is good because it's going to stabilize the stock price as it's going down. Again, because they pay a dividend. If it was just a growth company with no dividend, it would have a lot less institutional ownership. So other companies that everybody loves, Amazon has held up extremely well. If you want to talk about a company that's going to benefit from this, Amazon is absolutely going to benefit from this. Now, does that mean from here they go parabolic? Maybe they continue to consolidate sideways, but they're absolutely going to be a beneficiary of this, mainly because they're still going to deliver. No, they're not going to deliver everything, but they are going to deliver the essentials. And just by delivering the essentials, they're going to keep that revenue flowing. They'll survive the tough times, and then everybody's going to remember how Amazon saved them when they were in that tough spot. And when it comes time, they're going to be buying even more from Amazon. So Amazon is a great, great investment long term. They don't pay a dividend, so you're kind of just depending on appreciation. Um, Listen, they went parabolic here from 2017 to 2018. There's no doubt about that. From there, Amazon got cut by about 36, 37%, but it's stabilized. It's building a market around these prices. And again, they're going to be a beneficiary, so that's a very good thing. One of the other things I want you all to think about, kind of my last bit here, is if you are going to kind of evaluate some of these beaten down sectors. Now let's just look at X because I think Ryan had brought this up to me. So companies that are being priced at less than book value. So X is one of them, United States Steel. Okay, trading as low as it's ever been traded. If you want to look at like not Cliffs Natural, Cleveland Cliffs, but it's like Cliffs Natural Resources now or something. Prices that haven't been seen for a very long time. Okay, since 2016, this thing bottomed out in looks like January of 2016 around $1.50 a share. Listen, these are profitable companies. They pay a dividend. They are solvent. You know, it's going to be tough to hold these things. It's not going to be fun to hold these things, but you're talking about getting companies that pay a dividend at prices that like haven't been seen in so long that it's a good idea to consider these as the foundation of your portfolio for the next 15 to 20 years. FedEx is another one. A lot of people say FedEx isn't going to survive, but this thing's already been cut pretty deep, 60+%. Listen, FedEx is going to survive. They pay a dividend. So again, not a bad consideration if delivery is going to be a thing going forward, right? So if we're all going to be quarantined for 2 weeks to a month, it's a good recession play. All right. So that's it. I didn't want to make it too long. If questions, please feel free to ask. If you guys want any second opinions on your portfolio, if you want to just talk over, hey, I just went to cash, what do I do next? Feel free to reach out, ask if you have friends, family that are in a little bit of a tough spot. I know many clients, especially the ones that are nearing retirement, they want their money back, right? They're like, hey, thank you for getting me out early before we took the 30% haircut, but we want to make that 10 to 15% back up. How do we do it? When do we do it? So a lot of people need to have that conversation about really just thinking about being patient, not rushing back in. So much data is coming out every single day. The data flow needs to, one, slow down, and two, you can't really evaluate all the half measures. You have to evaluate this whole coronavirus thing based on all the full measures that are going to be taken. So, because we don't have the data to be able to make any kind of recommendations, the best recommendation is just to stay into cash. In a month, in 2 months, that's probably when you start having the discussion about getting back in. Gun to the head if you had to. I made some recommendations tonight. I think that's a good way to start. Don't pour your whole entire portfolio into those the companies that have been around that are undervalued. You don't pour your whole portfolio in now. You dollar cost average it in. You could layer it in however you want to do it. But there's no reason to jump into this market now. I mean, just today, I think we were down. I think we hit another circuit breaker today twice. So we were down at one point today. God, I think we were down like 9%. Yeah, I forget. I think we were down 8 or 9% at its worst today. I mean, it was ugly out there today. We bounced back, but look, we've bounced plenty of times in this, and we just keep going lower. So, just be patient, be prudent. Don't rush back in, and this too shall pass. All right, folks, have a good night.